spent a fair amount of time in Eastern Europe, so maybe in Europe, but I've also invested in private equity. Time back out, about Southeast Asia. So, have a pretty global view, and things I've done nothing but this for many, many years.
I remember one time you said, I know basically we can't do anything under 75 million. That was a different era.
Well, I think that's still.
52?
You really can't do anything in the wrong. Right, I spent some of my career as an institutional investor with a large Canadian pension fund holder. But in my career, I've been today I was on a special purpose vehicle, better known as a SPAC, which was 25 around from partner and a real interested investor in interesting strategy. So I'm always on my lookout when I'm in one of your events. But here today, inside my team. But so recognizing that what I and my colleagues do for a living, meaning emerging markets, alternative investing isn't necessarily the flavor of the month. Nonetheless, sometimes being contrarian is a good thing, which is why we're actually calculating it. Pre-IPO strategy. Going into this turbulent time period that we're in, obviously this weekend is salacious and not helping anyone. It's starting to look like 20 years ago when you had from Persians from the Lebanon side to like Israel versus Lebanon. You had the Georgian, invaded by Putin. So kind of every 20 years we have one of these periods of instability. I guess the way of saying this really sucks, but it will calm down. Hope I'm right. I'm not right, so what does all this tell you in terms of what allocators are doing? So, my perspective is one of a large institutional allocators. Although today, obviously, I say that allocators having way over allocated to expensive U.S. private equity strategies are now sitting on a bunch of stuff that's really expensive. They, however, have to go somewhere. They do have a denominator problem with the market. Look at that. Doing a little bit better from what they. Of course, everybody jumped on the private credit bandwagon. We heard a lot of that earlier today. Nothing wrong with private credit. Although it will come to say like 10%, of course, how much on it. No disrespect to private credit. I've done a bunch of it. So I think that is where the interest of larger allocators is today, and I think private credit is how de-risked is it versus private credit? So it's important as an investor. Look under the hood, look at the fine print, look at what the covenants, when we look at covenants, are we looking at what protections does the investor have against something happening with that piece of that is, and that it really is like that's important for our manager to show.
How are your covenants?
How are your covenants looking today? Are you feeling good?
They're looking better and better.
Good.
Look, I moved over to the private credit world 10 years ago now because, in my view, after we came out of the financial crisis, public, when I started in investment world, analysis was the value to outwork, out-analyze, out-gather information, and you could create sustainable outcomes. To me, that's, with information being as cheap as it is and disseminated as quickly as it is, that became an impossible game in my eyes, which is why I moved over to the private world, whether it be private equity, private credit, where I think you can create a sustainable outcome because it's still an extremely inefficient market and structure is a big part of that. example within my world is just, how do you structure a construction loan, right? It's putting up 75% of the money and someone puts up 25, they put up their 25 first and then your money comes in, which is a much more de-risked way, or kind of both put in money at the same time along the way, right? So there's many different ways to structure things that protect investors and provide a much better risk reward to micro situation like that. So to me, origination has become a new value add in the investment world, which I think a lot of us have talked about all day. And structure is an important part of it. You're seeing every originators as well.
Private credit.
I look, obviously, technology is an obvious place. I think that training. I'm definitely pretty concerned about geopolitical risks. I'm obviously they calm down. I think longer term we've got so many new issues. This world has confronted one or two major fronts in the history of the world, but we end up with issues with Ukraine and issues in the Middle East and Taiwan. So,
yeah, I think all very valid. I think the world change, right? I think part of being being flexible, being nimble, and being able to see relationships from occurring and kind of react to it. I think when I zero that down where we are today, I think there's a few places. One is sort of intense. That's structure like cable, satellite, wireless. Now we're kind of making a shift just because I think there's so much. I think the problem, one, this is obviously a huge trend that we all know about. Everybody's alive today. It is reading about what's happening in decarbonization. But I think the real change and kind of what pushed us in this sector is just the massive subsidies, right? Because a lot of these big projects aren't actually generating real returns without subsidies. So I think part of being nimble is watching where the changes are occurring. This affecting something like the IRA bill. We're involved in a reorg nuclear power plant where the IRA bill is basically putting more pricing in nuclear. So that creates a much more stable cash flow situation. And then these guys are actually building, they're building centers around the nuke. And so the interesting thing about that is, they're getting cheap power from the power plant, and 75% of the data centers cost is power. So these will be cheaper data centers to operate and run. And all of the energy is zero net, right? And so we have Microsoft basically talking about how they want to move all of the cloud and Azure into zero net data centers. These are the types of plays where you sort of have the government subsidy. You go to folks who are equity, which, is super cheap because it's underfollowed, and then you have a bunch of these secular trends that we think kind of create this stability and this growth. So I think that's one area we're trying to be a little play right now. Another one is actually what's going on with debt markets, and I think it's a little bit counterintuitive. I think there are businesses, John Malone, who we, follow, he's, often said a lot of businesses, are worth more debt than a lot. And so I think the interesting reason I bring that up is because you have businesses that are, and so I was talking to somebody earlier about one that we brought up to this group, a couple of years ago, and they have a maturity wall that hits in 2026. And they have 3 or 4 assets that we think they're going to sell before that period because they sort of have this. So there are a few other businesses like that isn't reflecting some of the parts valuation on small sector. And so the value here is, previously they had no incentive to realize asset value. So I think and we're seeing this in a number of places, right, where now they kind of have to realize assets, sell them down, and pay off debt, because, you know, they're never gonna be able to refi it the way they did. So it's just kind of a little, sample of the kind of stuff we see on where, where rates are, what we see in decarbonization, what we see in tech. But I think the overarching thought is just that in the public markets, right, we have liquidity, like private markets, and, you know, when you have that liquidity, you need to utilize it to move the way the market is moving. And the last thing I'll say about that is, you know, people were looking at the public markets very differently. Years ago, low rates versus now. And so, you know, everything we're looking for has real asset value, real earnings power value. So, and I think that's another big change as to where capital will rotate over time. So, one very long-winded way of saying, you know, we kind of turn the market, right?
Yeah, I totally agree with you, and I think that it is an important theme. It is narrow, but it exists, and I think there's been a kind of misunderstanding of what people are talking about. ESG frames or frameworks are put on companies, maybe for greenwashing for fun. I think that's true. It's sort of but genuine commercialization of technology, whether some stuff in the IRA, is, I think, a real preoccupation of institutional investors. To your point about the on companies selling assets, great point. Think about that. Who owns what? The big private equity owns. They can't sell their. So there's like the private equity come up to the company, and they can't further leverage that stuff because it's already leveraged. So the companies themselves are going to have to start selling stuff down, which will bring down the whole breakup. I don't know what that does for you. Private investors. Yeah, right. Yeah. So that should shrink the size of companies that are public.
Yeah. Well, I think at least from looking at it from a bottoms-up perspective from our side, you know, when two businesses in a similar industry, right? And so, I mean, I think that's where, you know, we'll look and we'll say, well, if X, Y, Z, that we should, someone who's doing, you know, public company. Don't understand. So we'll just, you know, it's case by case for us, right? We're, you know, there are other businesses for sure that, you know, we think are never going to get sold. And, you know, when they have remaining maturities, yeah, they're kind of sort of. And so, and we're seeing a lot of that kind of use case where you have a lot of brand, you know, you have white label competition, you're starting to see brand values decline, sales decline for a lot of household names. So we don't think some of those assets are going to get sold when they hit those maturity goals, but I think we're just trying to, again, it's all case by case for us, but we're
I think the other thing I would add to that, though, is you mentioned the market, which you're right. What you just described is terrible for the market, but it's great for some companies in the market. And I think we've gotten so heavy into indexing that we forgot that you can buy companies and they have a very different profile in the market. As we're doing in the private space, you can do it in the public space. Most public managers don't. They're all closet indexers for the most part. So what the world really needs is people to give something different in their public portfolios they already have, and that's what we try and do. So I think that's kind of the way to think about it is right. Most people are saying the market is going to get hurt. Yes, but we find these types of environments, low growth or disruptive environments, to be the best opportunity to get outperformance.
Right. Not when the market's going to get hurt means 10 companies.
Yeah. Well, actually, on that 10 company thing, I did look it up. I tried to get some data. For the last 40 years, the top 10 companies have averaged 22% of the S&P weighting. Now, right now, it's 27 for the Big Eight. So it is bigger. I'd also mention that the Mega Eight had a top PE multiple in the last 2 years of 38. They're down to around 26 or 24 now, I think is the number due now. It's come down quite a bit, so it's not as distorted as it was in the last couple of years because they've actually are real revenue generators and have stopped their big big bets investments and converted that into earnings, which is a change we have to keep in mind. That they got the big because they're smart, not because they're dumb. So I just throw that in the market. Public markets are very different, I think, than they were when I started 40 years ago, and even when they were 20 years ago. So I think you have to just take a different approach to it. I think most public market portfolios all look the same. So that's where a lot of the disillusionment comes from, is you move from one manager to the next, and you end up with the same stuff you had before. You're not going to add any value that way. For us, as you know, we've been very heavy in energy, industrials, materials, and healthcare and defense industry as well. And we intend to be there for a while. If you're looking for other areas I like right now, I would say I think China may be getting closer to bottoming than having further to go because of the steps they're taking. I wouldn't be rushing there, but for the global economy, that actually takes a lot of the pressure off and can give you a little bit better running start towards getting back on a better track with the global economy if they can stabilize. And I also believe rates are getting closer to peaking overall in the U.S., which will give you better floor on valuations and take the multiple issue and convert it to focusing on earnings. And I think that's where you want to be in the market we're in, is focusing on earnings rather than multiples, or in the private space, focusing on revenues rather than business plans. But quantitative matters now. I think that's one of the big changes, that 5% versus 0. I think we'll see that. I will say the other thing we're really, and when we look right now very hard, is Nitin was talking about the debt burdens on companies, public-private, are going to be the Achilles heel for them, and the ability for them to generate the revenues in this environment to match what their growing hurdles are going to be for their debt service. And it's going to be a bit of a challenge for a lot of companies, which will create some opportunities, but also create some real damage for portfolios. I think more of the stuff there.
Most of the audience doesn't realize we have a bit of standing tag behind. So my interpretation of an earlier call a week or two is you're sort of risk on. You were sitting on stocks and you weren't doing much, and now you're doing a lot more.
Well, yeah, just to speak to that point, we're in the real estate development game, real estate. Managed close to $2.5 billion here in the U.S. and $22 billion over Europe. We're seeing is this whole game of global, real estate is global, is really starting to turn, especially with interest rates and asset class understanding of what's going to happen with office. Take a look around at the office sector, most big cities, you'll see that even though most people have turned away from office space, still less available, and big funds of Brookfield just most recently they got downgraded by the credit rating because they're having to give that key. They were too heavy in one sector. People blow up in the industry. We're all waiting on watching the treasury go under. Most times time out but where's the treasury going? Everyone's trying to figure out this cycle, which no one can really, to be honest, no one has an understanding of really what's going on. No clarity of it. There's no understanding. When you have that, people are hesitant to make moves. But the problem we're finding with hesitating in a very poison market is that not, I know especially for an asset manager, if you're not putting your capital out there looking for deals, the fund's not going to make those hurdles. Investors are not going to get the return. They're going to be upset. When they give you that money and trust you to go invest with them and actually make deals, not sit on the top and wait for something golden to happen. They expect you to find the golden and create the golden. So for a while we were waiting like everyone else, looking at the sidelines, but it came to a point where our credit committee said, if we don't start making investments, our funds are just not going to be able to make a long-term stand and not be able to really return our investments. And the pensions that rely on us to make these investments for them, they're going to have issues with who they have to support us. And it's the whole chain. I guess, bring a little clarity to what I'm saying. The asset class is really what you're going to see the big definition of what's going to happen. The asset class. In big cities like New York, building like this is sitting 35 to 45% vacant, while one Vanderbilt, you can't get into the door. So why is that? It's access. People have to come to our office. We want a place where we can literally get off the train in the winter and come right up. Not people ever walk outside. versus coming here, guys can stay in remote work works. Why should they ever come into an office? This is that. There's landlords cannot pay more. You know that people in this building, they're crying. They're desperate for people right now. They can't get anyone, or they're showing it daily. Everyone's like, yeah, and they can't pay those per square foot prices, and they don't get those per square foot prices. Their mortgage goes on there. Another big issue that no real estate in big cities like New York, LA, Chicago, the land is not owned by the developer of the building. It's actually owned by a land leaseholder that owns typically the city. New York is a common place where the city owns the land underneath. So when the state or the city owns the land, you have to renegotiate the land with how your expenses on top of taxes. A lot of these assets are going to have a lot of issues. So, and that automatically is going to cycle through the rest of their assets, because if they can't pay the bills for this building, they're also going to have issues creating with their other assets that don't, that are outside of this asset class. I think that happens. These are getting back to dealers. We're going back to banks and saying, here you go. Now banks are becoming the largest owners of kids. They're not in that business. They don't want to own those. They don't know what to do.
How do you make some money from that?
The way you make money from it
Yeah.
is working with the local politicians. We have assets. So say, look, this building doesn't work anymore. The apartments that are there that are fully full, they can trade for apartments that are less than 3% of the city. How do we create co-work spaces?
Wall Street Journal did a great 10-minute video about a month ago about what it takes to turn a building like this into a residential building. And they said that most developers today are favoring pre-war buildings that have an open core, so they have light and ventilation. And where they don't have an open core, buildings in New York City are actually building them. They're cutting a hole in the middle of office buildings. And they're creating cores. It's a really cool video. It's about 8 or 10 minutes long. It's on wallstreetjournal.com.
Just a quick question on, you made the assumption of electrification. It was pretty bullish and specific. Some other people receive what you pretty heavy to do with energy, does the active energy. How are you playing that sort of opposing mandate?
I'll start from our long portfolios. We're playing both sides. We like the fossil fuel industry. We're fortunate to have owned Pioneer as it's being taken out. So we're playing that, but we also play some of the renewable plays through two ideas in Denton. One was Flex, and the other was Array Technologies.
Yeah, I mean, I think, again, it's some, I think we can go into the details. I think this transition is going to take a little long time. And I think there are certain areas where it's not going to go as expected, and, there are really good returns, and then there are probably good returns. And so I think, again, IRA helps support some of the higher return on capital. And so, so I mean, I think that's a big picture way of saying that you just have to find the right time. And I think that's what you get paid. So we're in a company that was a legacy refinery, and then they retrofitted it for renewable diesel. And now they're sort of shifting into sustainable aviation. So I look at something like that, and I think, you're getting sort of your typical diesel price on top of IRA subsidies and, California LCFS. And so when you sort of layer those in, it becomes a very, very high return on capital in terms of the retrofit they did. So it's very much one-off, the way of it, right? Like Stephen mentioned, we were in some solar trackers. So trackers are the device that goes on large-scale football fields with utility solar panels. They move the panel direction of the sun, so you get 15% better efficiency. Track moves based on the sun moving, rising west, setting the west. And so the point being that this is basically 4 to 5 players in this business. They're very rational. You can kind of look at it like auto parts, where commodity products, but nobody wants their tracker to break because of the entire